Hello, Market Insights watchers. Well, for this week, we have a very special treat. Ian had a chance to sit down with Money and Markets Adam O'Dell and had a great interview with him. So, Ian, what can we look forward to in this interview?
That's right, Amber. You know, Adam is such a smart guy. I love having the opportunity to talk to him and bring his insights to our viewers. I mean, he's got a really unique take on this war between fossil fuels and renewable energy. Of course, you know, we've covered it extensively on Strategic Fortunes and also Market Insights. And he's got this really interesting company that was playing both sides of fossil fuels and kind of towing the line between fossil fuels and renewable energy. So I'm sure our viewers are going to love this.
Awesome. Well, everyone, please stay tuned and enjoy the conversation.
Adam O'Dell, Money and Markets editor. Great to see you. What's going on?
Great to see you, Ian. Glad to be on the show again.
Yeah, it's great to talk to you. So, you know, we've been hyping you up. You've got a really unique take on the energy sector. It's not really our forte in Strategic Fortunes. I want to talk to you, hear your thoughts on what you're seeing, what kind of investments that you're doing. But you know, you've had a really unique take on this kind of war that's developing between fossil fuels and renewable energy. Like, what have you done in the last year to kind of toe that line, I would say?
Yeah, I mean, it's a good use of the word war, sensitive word. And first of all, you're not giving yourself enough credit. You're certainly an expert on the renewable energy side of the equation. And I certainly see a lot of growth opportunity there. I mean, the CAGRs, the annual growth rates of those technologies are mind-blowing. I saw something that upwards of 80 to 85% of all new planned capacity for power generation in the US is going to solar and wind and battery. So that certainly has the growth rate. And if you're a growth investor and you know how to spot those trends, there's a ton of opportunity on the renewable energy side. But the way I see it is it's a false choice to just think that you can only invest in one side or the other and do well, meaning fossil fuels, oil and gas producers, or renewable energy companies. I see them as kind of both competing for investors' capital, but I see opportunities on both sides, and they're different types of opportunities. As I mentioned, I see growth on the renewable side, but I see value on the oil and gas side. I mean, oil and gas went through a really nasty bear market from 2014 to 2017, and they kind of just dragged along.
I remember
the bottom.
that.
You remember it was tough. And then even in 2020, we just talked earlier about how oil prices went negative in 2020. Everybody thought that the sector was just left for dead. So you have its own bear market, but then you also had ESG, where environmentally conscious investors were shunning oil and gas producers, not investing in them. And it really created this situation over the past decade where now the oil and gas sector is one of the cheapest industry groups out there. Not only are they one of the cheapest, but they have tons of kind of implied leverage in their operating earnings, meaning that for every 1% rise in revenues, that they increase their revenues, they get an 8.7 times increase in operating earnings. And that's the strongest leverage of any sector out there. So really, I mean, these companies, the ones that survived that bear market, are lean and mean, their cost structures are low. And so really every bit of extra revenue falls straight to the bottom line. And now, rather than investing in increased production, I know a lot of energy bears are worried about, oh, they're just going to start producing a ton and that's going to crash the price of oil. But really, rather than ramping up production, they are sending that money back to shareholders in the form of buybacks and very fat dividend checks. So it's really a good time to be in those stocks as I see it.
Yeah, and not every oil and gas company is created equally, right? Like ExxonMobil is not like a small wildcatter, they do upstream and downstream operations, but you kind of look at the whole picture and find specific companies that have the right fundamentals behind them, that even if the price of oil or natural gas drops, they're not over leveraged the sector, which I think was a lot of the problem that happened in 2014, 2015. There was just so much leverage that was added to these companies, and there was a fracking boom. Everybody got excited about it. There definitely was some overproduction, and the price of oil went down a little bit, and everybody realized that the leverage and the cost basis of getting out of the ground was way too high. And also you activated a lot of different places. So above $80, then you start getting tar sands in Canada. At $60, you get fracking. Of course, it costs nothing to get oil out of the ground in the Middle East still. So there'll always be the producer of last resort. So what has been a specific company that you've looked at in your portfolio that has really done well for you guys?
Yeah, I mean, it's a good point because the majors aren't necessarily the best place to invest. I mean, the kind of the XLE, the Spider Energy Sector ETF, is what most people go to if they're just wanting to add exposure beyond the S&P, weighted market cap. And if you use my Green Zone rating system, the XLE actually rates the best overall across all of the 11 sectors. But really, that's still concentrated in very large cap. The Exxons, the Chevrons, those are companies that are doing these mega mergers now and trying to integrate even further. But I really see a lot more value in the kind of the mid cap space. We do hold some small and not micro cap, but small cap space names. One of them is about 650 million rather market cap, and that's just after it doubled recently. But there's one company I'll kind of name here. It's Civitas Resources, CIVI is the ticker symbol. Right now they're just under $7 billion of market cap. What's really impressive with them is they're still trading very cheaply, even after doubling over the past couple of years. They trade at less than 8 times price to earnings ratio. They trade at 1.1 times book value and next 12 months sales. So they're still really, really cheap compared to the energy sector and the market as a whole. But their margins are really strong. They have about 40% operating margins and 25% net profit margins. And their free cash flow, I mean, next year they're forecast to produce about 335,000 barrels a day. And at that rate, even if crude was at $70, which has, right now it's in the upper 70s, but even at $70 a barrel, they're going to generate $1.5 billion of free cash flow, which against their market cap of under $7 billion is like a 22% yield. So if you look at a company like Google over the past 5 years has averaged free cash flow yield of about 3.5%. So you're looking at about 6 to 7 times that. So it's just really, again, because a lot of these companies got lean and mean, then now every bit of revenue increase goes straight to their bottom line, and they're really paying that back to investors.
And so what does Civitas do with that? Do they pay a healthy dividend, I guess, with the cash? Or they investing in operations?
Yeah, they have an active buyback, share buyback program, and they're paying a dividend. I think over the next 12 months, it's expected to be about $7.60 per share, which is just over 10. It's about 10.5% yield. So wow. Again, they're really giving that back to shareholders. And so really with this type of stock, you can get a very fat dividend, more than you can get on 10-year treasuries, and a lot of capital appreciation as well.
Yeah. And you know what? I just think viewers need to keep this in mind. Like, I'm glad you brought up the point that like most people, they want exposure to energy, like my financial advisor just goes and buys like the XLE. If you had done that in June of 2022, right? We've heard all this about energy over the last year, how energy is coming back. If you had bought the XLE in June of 2022, and loaded yourself with the majors, you're actually down. You're down about 10%. And so like you kind of need someone that can guide you to help to understand like the companies that are better positioned, rather than just, blindly buying one of these index funds that to me feels like a little too much levered to like the underlying price of oil. And like you said, there's a lot of opportunities that are trading at very deep value opportunities that are just missed by buying these ETFs. So where can people learn more about this, Adam? Do you have anything we can share? Can we share a link?
Yeah, we'll put a link here. But really, I mean, this is a theme that I hit on throughout all of my services, whether it's Green Zone Fortunes, my front end flagship newsletter, or 10X Stocks, one of my back end stock trading services. But really, I do see, the oil and gas sector is in a multi-year secular bull market. And just as everything that goes through cycles and waves, I mean, we really saw the first rally from the 2020 low up through about 2022, when crude peaked at about 110, 115 a barrel. And yeah, you're exactly right. XLE has been a horrible trade over the past, 12 to 15 months. But I see that as kind of a orderly pullback. And I do think that we'll have another rally over the next 18 months or so. But you're right. I mean, XLE or any ETF is rarely the right way to go. You get the good, bad, and the ugly all mixed in there together. And that's really why, a deep dive research or a rating system like we bring to the table is needed to find the best names.
Awesome. So anyone that wants to check it out, click the link in this email, learn more about what Adam does over at Money and Markets. Adam O'Dell, thanks for joining us, and we will talk to you again soon, hopefully. Take care.
Yeah, thanks for having me. I appreciate it.